Conrad Pawlowski from Family First Life Midwest out here in Livonia, Michigan. Today I'm going to do a little product training, and I'm happy to be able to give back today by helping out with this. I'm going to be talking about the American Amicable life insurance product called the Secure Life Plus UL. It's occidental in some states like Michigan, where we don't have the ability to write American Amicable and Occidental side by side. And they are two different websites, but you can access the product from either one. I want to point out right away, this is a niche product. It's not something you're going to write every day. It's a universal life policy, so the policy can be designed to be permanent, like a whole life, and it can also be designed to look like a term. And I'll go over a couple of scenarios with each of those. But first I want to go over some of the features and benefits, and then I will go over some of the scenarios where you would pivot to this product as needed. First, let's go over some of the free built-in riders of this policy. It has terminal illness acceleration. So you can accelerate the policy up to 75% of the policy face amount, or 100,000, whichever is less. And that is if the person is diagnosed, the insured is diagnosed with a terminal medical condition. It also has a built-in free waiver of surrender charges on cash withdrawals if the insured is residing in a nursing home. So after 1 year of the policy, a universal life policy has a surrender charge period typically of 15 years. And so when somebody has a policy that's been in force for a year, it might have some cash value, but some accumulated value, but the cash value is typically zero because the surrender charge would kick in and the insured would not be able to access any of that money. So in the case of somebody getting, let's say, recovering from an accident in a nursing home and they needed some money, and their policy has been in force for a year, but they don't have any cash value, although they've got accumulated value, they can exercise this free built-in benefit by it allows them to take up to 25% of the policy cash value in a year without any surrender charges. So it's a way for them to have a little bit of access to some money that they might not otherwise have in the event of that accident or something that would put them in a nursing home, typically residing there for, I would say that it's not going to be a permanent stay, let's say, and that's where this next rider would kick in. So there is a nursing home confinement acceleration where the person is confined to a nursing home. They can accelerate and take up to 2.5% of the policy face amount monthly, up to $5,000 per month. And that is, of course, up until the policy is exhausted. Of course, the average stay in a nursing home is typically 2.5 years before somebody passes away, and so you wouldn't necessarily exhaust the entire death benefit if someone who was confined to a nursing home. Some of the add-on riders that you can get with this policy is, first one is accidental death. You can add on up to $150,000 worth of accidental death to the policy, and that accidental death rider falls off at the age of 65. So it's not something that they're going to have into their old age, like something that's built in to an Americo Eagle Premier, where that accident is always there, whatever age. This one is going to fall off at age 65. It also has a children's insurance rider, and reading over this rider makes me think that we don't do enough of these, because this is something that can certainly add to persistency. Let's say that somebody's got a Brady Bunch family. Well, this covers all the children in the family for one price. You can get between 2 units and 25 units on the policy. Each unit is $1,000, so a minimum of 2,000 up to 25,000. It covers all the children. So let's say the two people get married, they each have 3 children, it covers all 6 of their children. Let's say they expand their Brady Bunch and they have 3 more children after getting together, they have a total of 9 children. Those 3 children were born after the policy was put in force. Those children are covered as well. So all 9 children are covered for the same price, and they're covered for that amount all the way up to their age of 25. If one of those children had a significant medical condition that would keep them from getting any life insurance coverage, this is going to protect their insurability. Like, let's say one of the children has a hole in their heart, a genetic defect in their heart that didn't close up. They can convert this policy to a another policy with American Amicable, up to 5 times the number of units, or $50,000, whichever is greater, or whichever is lower. Sorry, so 50,000 is the max. Then there's also a real unique one that is a term insurance rider. You can add up to 4 additional adult insureds onto the primary person's policy. One of those insureds can be the actual primary insured themselves. So I don't know if when you're out in the field and you look at policies, you read them, you get to know them. Occasionally, you come across a policy where a person has a term insurance rider on themselves, and so this is the only one that I know of that we have, that you can add more coverage on yourself. You can have a permanent base coverage in the UL part, and then you can add on a term coverage up to 3 times the policy face amount. So I'll talk about that a little bit later, where that would be something that'll help you guys out when you reach certain scenarios. You can pivot to this product. Then another add-on is something called a waiver of policy fees on total disability. So in a universal life policy, in addition to the cost of insurance that's part of the premium, there are also policy fees. And so if you choose this rider, it will waive the policy fees, not the entire policy premium, but just the fees within the policy that you might not necessarily see. But if you're totally disabled prior to the age of 60, there's a 4-month waiting period. Those policy fees will be waived for the life of the policy. Well, what would that benefit you? Well, it would help your policy last longer. It would help it accumulate more cash because the policy fees aren't there going forward after total disability. There's also a waiver of specified premium on total disability up to age, if that occurs prior to the age of 60. So that would be the case where somebody's totally disabled prior to the age of 60, their entire premium is waived, up to a maximum of $400. So you can add that on. That also has a 4-month waiting period to eliminate a case of somebody who might be, I suppose, faking it. Then there's a total disability income rider that will pay out a monthly benefit for up to 2 years for 2% of the policy face amount, up to $2,000 per month. The minimum amount is $500 per month. So between $500 to $2,000, $2,000 is a maximum. You can go up to 2 years. This total disability has to occur on the insured prior to their age of 65, and in this one the elimination period is only 60 days, and the benefit is retroactive. So somebody applies for this for this particular waiver or income rider. then that elimination period is shorter. It's only 60 days, and then after it's approved, they will get the income for those 2 months since retroactive since they applied for it. This universal life policy also has a pretty good long no lapse guarantee period of 20 years, or up to age 90, whichever comes first. So I'll talk about some of the ages here that you can write this policy. This is probably the main reason I looked at this is because you can go from age 0 to age 80, and we don't really have anything that it really fits that for a smaller UL. And so when you when you blend that with the no lapse guarantee, you can come up with some unique solutions for your clients. Like, let's say you've got a 73-year-old person, and they really want a term policy, or they really don't think they're going to live past 90. Well, you can get this person really a 17-year term. You can design the policy to run at the minimum. It'll be guaranteed to last all the way to age 90, or 20 years, whichever comes first. In this case, age 90 comes first. So he has it for 17 years. Typically, I use Americo's LifeCrest Index for my universal life in the age band of 55 to 65. Like this product, Secure Life Plus UL, it is um, it is standard or better, so you can't have um, any rateable condition with LifeCrest Index. Uh, so I'm typically writing the American Amicable Secure Life Plus on healthy people standards, healthy seniors standard or better. But the Secure Life Plus UL will go all the way to Table 8. Um, if somebody is rated, there's probably some other policy I'm going to write them, like a whole life policy, versus putting them through um, getting table rated. But so LifeCrest Index is what I use for that healthy person between 55 to 65. After that, I'm using Americo's LifeCrest SI. That's also simplified, and there's a little bit more table built in there. It's kind of like HMS, 3 or 4 tables of risk. Um, and so that one I'll use that for people aged 66 to 70. After that, where I can't use LifeCrest SI, I generally go to Forrester Smart UL because it goes up to age 75. So for people 71 to 75, I use the Smart UL. Bef- Before the Secure Life Plus with American Amicable, I didn't have a UL to offer a client as a solution if they were above the age of 75. And so the Secure Life Plus UL goes all the way up to age 80. So this will fill that niche of getting a UL on somebody who's age 76 to 80, where necessary. So it's a great fit for that healthy senior. But again, I'm really writing it on folks who, if I'm going to write it on a 76-year-old, they're they're going to be pretty sparkling clean health. Um, so otherwise, I'm going to write them a whole life policy to get them permanent coverage in a different way. But the Secure Life Plus UL is underwritten by closest age. So if I'm writing a policy today in July, and my client is currently 75 years old and turning 76 in October, well, that's 3 months away. They are closer to 76. So even though today they're 75, the product eligibility and premiums will be based upon their age of 76. So it's going to be priced as 76. Also, if you download the underwriting guide for this, it's got a neat product category grid, and that really helps you out to determine where you want to write this product. So the minimum face amount for this policy for standard non-tobacco and tobacco is only $10,000. We don't have any UL in our matrix of carriers that is really like a micro UL. that you can write at a face amount of $10,000. All the other products I've come across have a minimum of $25,000. So this makes it a great replacement tool on those folks at higher ages that are really healthy. Preferred non-tobacco is available at a minimum face amount of 100,000. So if you look at the underwriting grid in that agent guide, it's a little quirky, um, but I'll give some insight on the top choices for writing this product, and here's where I would write it. So if you look at that underwriting requirement age grid, it's from ages 0 to 50, and face amounts up to 99,999. The underwriting is non-medical. So that's where we serve our clients best. Simplified non-medical insurance. So you can get a baby a UL, and now note that you will need a juvenile questionnaire for uh, children aged 0 to 17, and I should say that it is simplified in most states. There are four exceptions: California, Connecticut, Florida, and Maine, where a swab kit is required. I don't know why somebody would want to swab a 3-year-old for nicotine, but in those states it's required. Um, and so also make sure that you have the supplemental questionnaires, because they are required. It's not integrated into the application like the high blood pressure questionnaire, the respiratory questionnaire, etc. There are a lot of choices in this age band of 0 to 50. So you might say, well, why would I write somebody this 0 to 50 when if they're healthy enough, I could get them Americo cash back if they qualify. Yeah, and that's where I'm going to. But there are a few cases where this can make sense to pivot to. I like one of those cases is and I'll talk about a bit where later where somebody says to me that that they don't believe in being overinsured. So I'll talk about that a little bit. Um, Ages 66 to 80 is another age band where I will write this. Now, ages 66 to 80, there is an APS underwriting. So that's very similar to Americo's LifeCrest Index. They will waive the APS if the health is clean. If there is something in the record that the underwriter needs to address further to make sure that they're eligible, they will Americo will order medical records on a LifeCrest index policy. But and so that's similar here with the Secure Life Plus UL. There is an APS requirement, although it can be waived by the underwriter. So and APS, by the way, stands for attending physician statement. Is basically a look at the client's medical records, um, and again, it's at the discretion of the underwriter. Um, so the minimum face amount of 10,000. If you do 100,000 for somebody who's 66 years old, they can actually get preferred without a medical exam. That's another niche. Is that all we with Global Atlantic there is a fast lane underwriting where somebody can get a UL, um, that if they're healthy enough they could get preferred or premier status and waive a paramed exam. Well, when you get above the age of 60, you can't do that with Global Atlantic. And so that's a unique niche here with this product is between the ages of 66 and 80. And get this, for a face amount up to 500,000, only an attending physician statement is required. So that really helps out where you could potentially get a 77-year-old a preferred health rating on a policy that he doesn't have to take a medical exam for. So that's really strong, and I'll talk about those cases also where we're in a mortgage protection appointment, and this would be a great fit. Um, so notice I skipped the age band of 51 to 65. That's because at any face amount from age 51 to 65, a paramed exam is required with the Secure Life Plus UL. And there are too many other choices that Family First Life has to serve to serve clients better, that I would put them in that age band between 51 and 65. So if they're 51 to 65, just block it out of your mind. This product just is not the fit. Why would anybody put a 51-year-old through a paramed exam with blood and urine on a $10,000 universal life policy? It seems to me like American Amicable might lose some money on that one, but I didn't design the product. So, so 51 to 65, just leave it alone and go someplace else. And so up to 50, it's non-medical, and for face amounts less than 100,000. Age 66 and above, it's APS underwritten at the discretion of the underwriter. Just bear in mind they probably will order an APS unless it's super clean. And as I mentioned, I like to underpromise and over deliver. So I'm typically writing this on the people who are standard health or better. I don't want somebody to get hit with a higher cost because they came back table rated. Um, Again, I'm going to pivot to something like whole life for that senior if there's anything like that. You can run an illustration on the American Amicable or Occidental websites to calculate the premium. I suggest your first few times through that you call their sales desk and have the sales desk walk you through the steps of running an illustration. It is not an integrated application like the Americo HMS, where the sub questions for something like diabetes would fulfill the necessary underwriting requirements. For the AM Secure Life Plus app, you will need all the supplemental questionnaires. It is unfortunately a paper application only. There is no AM mobile tool for it, so you'll have to download those paper applications and questionnaires. There is a build chart for it for the preferred and the standard rating. If you go above the standard, person could be table rated. So keep that in mind. So where would I use this policy? Well, there's that guy, as I mentioned, who says, well, I'm not I don't really believe I should be overinsured. I'm going to pay this house off in 10 years anyway. Well, you could use that term rider to build something for him that fulfills his mindset of not being overinsured. You can add a 10 to 20 year term rider on himself. So let's say this 50-year-old guy has uh, a $90,000 mortgage, and you get him a $25,000 UL, and then you add on another $70,000 of term life rider on himself that drops off after 10 years. So then he's not, in his mind, paying too much, because during that period where he's going to be accelerating his payments to pay off his house early, he's going to have that coverage. He'll have a 10-year term built into his policy that's going to give his total coverage, let's say 95,000, and then another 25,000 after that 10-year drops off. He'll have a permanent policy. So you can give him the term perm combo in one policy. Then that leads me into the family who wants to be protected on one policy. I don't know if you've ever heard people say to you, don't you have just one policy that pays off the house if any one of us dies? And of course you got the mom in there who's co-signed on the mortgage, and she lives with them, so you got three people. And so you could put, let's say, the younger wife as the primary on the policy, and then add on a 20-year term rider on the husband and a 20-year term rider on the mom. So that can be a cost-effective solution where people want it bundled into one policy. And oh, by the way, they're probably a Brady Bunch, so you put in the child rider as well. Um, and let's take the 80-year-old man who you go into either a whole life or a mortgage protection appointment, and he says, I doubt you'll be able to do anything. My wife filled it out. I already have $10,000 in coverage, and we can't afford any more. Well, this 80-year-old man, maybe this is that one that's super healthy, that doesn't take any medications, and I don't want to pay too much. I'm gonna live to age 120, and so Here you can go ahead and design a policy to age 120. That's $10,000. Have him pull out his policy, and you look at it, and let's say it's a Mutual of Omaha policy that's 5 years old, and you're scratching your head like, well, I don't have anything that's really going to beat this. You take a look at that policy, you explain to him the reduced paid up benefit, and you help him first get the policy issued, the Secure Life Plus policy issued, and redirect that premium into a new policy that's $10,000 for either less money or the same price. And then he takes his previous policy, let's say it's a Mutual of Omaha Living Promise, and convert that to a reduced paid up policy. So now there's no more money out of his pocket, and let's say his reduced paid up policy is $4,000 of reduced paid up insurance, and his new UL is 10,000. Now you've walked in there and increased his death benefit by $4,000. His wife is the one who filled it out. She felt like 10,000 wasn't enough, and you didn't take any more money out of their budget. So that's a niche for this. The other one that I talked about was, let's say, the 77-year-old who's got a big mortgage and he's healthy but doesn't want to do a paramed, or doesn't think, or you don't think it's wise for him to go through a paramed, and he's got a big mortgage. Well, you could do a $400,000 or $500,000 UL that's only APS underwritten, and you could either design it to be a 13-year term that expires at age 90, or design it all the way to age 120. Either way, the person could get a preferred underwriting status and no paramed exam. So in summary, it's a niche product with some unique benefits to have in your tool bag. It'll help you get a few extra sales per year, help you think in a little bit different way in terms of your problem solving with your clients. So I hope this helped, and go out there and help some more clients. Take care.